Welcome, students. So, in the process of learning about the different capital budgeting techniques, in the previous class, we started talking about the internal rate of return. So, I told you in the previous class as well that we will continue our discussion from this particular technique of the capital budgeting. So, we have discussed the preliminary part of it, the initial part of it, that what the IRR is, internal rate of return is, and how it is different from the NPV, net present value. So, in one case, the NPV, under the NPV, the discount rate is known to us, whereas in the IRR, the discount rate we have to find out. And final objective is that under both the situations, decision criteria would be same, that we will like to make the NPV 0, and we will like to see that if the NPV is 0 in the foreseeable period of time, then fine, we will go ahead with the investment proposal. Otherwise, we will drop it if it is negative, especially, and if it is more than 0, then it's really good. So, that was the initial discussion we had about the internal rate of return, or this IRR. And after that, now we will try to understand about it, that how we calculate the internal rate of return. So, for the calculation of the IRR, we have to understand with the help of certain cash flows, and then calculating the present value by using the different discount rates, and trying to understand that how the correct IRR can be calculated. So, in this case, for example, we are given the three situations, and we have the cash flows. We are given the cash flows, which is basically one cash flow only, and this is the one series of the cash flows. And when you talk about this series of the cash flows, so we can say here that in this series of the cash flow, we have this all the years from 0 to 5. So, 0 is basically the current period in which we are going to construct the venture, or maybe that's a construction period for us. And during this period, we have an outflow of the 100 million, or maybe the 100 thousands, or 100 lakhs. And after this, for the next 5 years, year 1 to 5, we are going to have the cash inflows only, which is 34, 32.5, 31.37, and 30.53, and 79.90. So, different, you are given the different inflows, and one outflow is given to us. This is 100. So, after making the investment of the 100 million, we are going to get the 5 inflows over the period of 5 years. And since we are using the period of time concept here for discounting the cash flows, so we assume that these cash flows are occurring to us at the end of the period, or maybe the end of the first year, end of the second year, end of the third year, end of the fourth year, and end of the fifth year. So, these are the 5 cash inflows, and one is a cash outflow. And ultimate objective is what? We have to make the NPV 0. We have to see that at what rate the NPV becomes 0. That will be called as the expected rate of return. And then we have to compare that expected rate of return with the required rate of return. And then we have to see that if the expected rate of return is equal to the required rate of return, we will accept the venture. But if it is other way around, if the expected rate of return is less than the required rate of return, we will abandon the proposal. And if it is other way around, that is, the expected rate of return is more than the required rate of return, so in that case, we will have to accept it in any way. And if the expected rate of return is equal to the required rate of return, in that case, there is no problem, and we will accept, because NPV would be 0 at that point. And that we want to check that in how many years the cash outflow can be recovered, and NPV of the projects become 0. So, in this case, for example, first we try the discount rate of the 20%. To discount these cash flows, we try the discount rate of 20%, and using these discount factors under the 20%. So, one construction period is the 1 year, means the year 1. So, that is, the value is equal to it's the face value. So, it is 100 million is equal to 100 million. So, no discounting is required here, because it is a current period, but we are discounting it here against these periods. So, 20%, and the discount factor is 0.833, 0.694, 0.579, and 0.40, 0.482, and 0.402. When you multiply it with this, so finally you get this value, and these values are available out of it. And if you calculate the NPV of the project, it is 15.88, which is more than 0. So, we can say that NPV of the project is, since more than 0, it means that total present value of the cash inflows is more than the present value of the cash outflows. So, it means the expected rate of return from this venture is not 20%, but more than 20%, right? So, how much it is more? We have to find it out. So what we do now, we increase the discount rate from 20% to 24%. And when you increase it to 24%, when you increase it by the 4 percentage points, so your discount factor changes. And when the discount factor changes, present value also changes, and especially the present value of the inflows also changes. And finally, NPV goes down because you have increased the discount rate, but NPV is still positive. It's still more than zero, and it is 5.13. Earlier it was 15.88 million, but now it is 5.13 million. It is less than the first one, but it is still positive. So it means it's giving us an indication that the expected rate of return from this investment option is still more than the required rate of return, right? So it means we have to further raise the discount rate and to try to find out that finally what is the expected rate of return from this investment proposal or this particular venture, and then we have to compare it with the required rate of return and take a call. So we increase it from the 24% to 28%. So when we increase from 24 to 28%, so the NPV of the project becomes negative, right? It becomes minus 4.02. Now it's a clear indication that discount rate or the expected rate of return from this investment proposal is certainly more than 24%, but yes, it is less than 28%. It means the discount rate, the expected rate of return from this investment proposal lies somewhere between 24 and 28%, right? 24 and 28%. So what is the exact internal rate of return available from this investment proposal? And that we can find out with the help of this particular model. And here this model, when we are using it, finally it's going to help us that the final internal rate of return available from this investment proposal, expected rate of return available from this investment proposal is 26.24%, right? At this 26.24%, NPV of the venture would be 0. NPV of the project would be 0, and that would be now comparable to the required rate of return. And if the required rate of return is, for example, 15%, for example, when you go about the comparison of the required rate of return with the expected rate of return, many surveys have been conducted in the market, maybe in India or abroad, and normally people use 15% as the required rate of return, because normally weighted average cost of capital remains 15% around. So in this case, for example, if you compare that 15% with 26.24%, it comes out to be significantly higher. So it means you can say this kind of the investment option, this kind of the investment proposal is very good, and we would certainly like to make investment in this project or this venture. So how we calculated this 26.24%? So the formula is very simple. You have to take the smaller discount rate, which is 24%, at which the NPV was still positive, and that was how much? 5.13, right? We have taken this 5.13. The NPV was the 5.13 at that rate, and after this we have to take as a numerator NPV at the smaller rate, which was 5.13, and sum of the absolute values of the NPV at the smaller and the bigger discount rates. So it is 5.13, and we have to take it as a 4.02, but we have to not to take it as a negative sign. We have to take the sum. So though it was minus 4.02, but we have not to make it 5.13 minus 4.02, rather we have to sum it up. When we sum it up, and with this total value, summed up value of the 5.13 and 4.02 here, means which is the sum of the absolute values of the NPV at the smaller and the bigger discount rates. When with this sum, when you divide the NPV at the smaller rate and multiply it by the bigger discount rate at which the NPV becomes a negative, and the smaller discount rate at which NPV is still positive. So if you take the difference of these two discount rates, and finally if you solve this, so you will find out that finally the internal rate of return available from this venture is 26.24%. 26.24%. So it means this is the expected rate of return available from this investment proposal. And now if you compare it, if your required rate of return is 15%, the difference is big, and we have to go anyway, we have to go for this venture. And if it is 20% even, So required rate of return and expected rate of return, there is a difference of 6.24%. So we will still go for the venture. So only you can drop this venture if your required rate of return is more than 26.24%, which will seldom happen. And normally the cost of capital in India, or maybe around the globe, if you talk about India, the cost of capital is little higher as compared to the other economies. So in India also we take around 15% of our say discount rate, or maybe considering it as the required rate of return. So against this, the available rate of return is very high. Internal rate of return from this investment proposal is very high, and we will certainly accept it. And this way we can calculate the exact IRR available from the investment proposal or from any project. So if the NPV is positive, you have to increase the discount rate. But if the NPV is negative, so you have to decrease the discount rate, because finally we have to find out that discount rate, which will be called as the internal rate of return, where NPV becomes 0. So in the present case, we saw that we started discounting the cash flows with the 20% still positive, 24% still positive, and then when we use 28%, it became negative. So we found it that it is somewhere between 24 and 28%, and exactly it is 26.24%. So we could get it, we could find it, and this is the way we can calculate the internal rate of return. Right now, we come to the very, very important part of the discussion, that some limitations of the some problems of the IRR, which it makes us to use it very carefully, and we have to be very particular. We have to be very careful while making use of this IRR, internal rate of return, and for that purpose, we have to take all precautions. First limitation of the IRR is, first problem of the IRR is non-conventional cash flows. Right, non-conventional cash flows are basically something like this, that you have non-conventional cash flows. In this case, for example, you have 0 period. C0 is the current period or the construction period when we have the cash outflow of the 160,000 rupees. And in the year 1, C1, in the year 1, you have the first inflow of the say 1 million rupees, 1 million Indian rupees. And in the C2, again, you have the cash outflow of the 1 million rupees. So you have 2 outflows and 1 inflow. So in this kind of situation, because normally what we say, we assume in the traditional analysis, till now what the analysis we have done, we have assumed that cash outflow is only in the 0 period or in the initial period. One period only, that is a 0 period, which you call it as the construction period. And after that, in the subsequent year, there are only cash inflows. So we assumed that the construction period value of the cash outflows is equal to 1 or multiplied by the 1. So it is the same, it is 100%. And the cash inflows value we have discounted. But in this case, now what is happening? It's not a conventional cash flow. It is a non-conventional cash flow, where in the first means 0 period, there is outflow. In the first year, there is inflow. And then in the second year, there is again outflow. So what will happen? Means you try to understand the situation like this, and for this purpose we have to use this means kind of the series. So it means for calculating the IRR for the non-conventional series, you have to understand it with the help of this. So we have a cash flow stream here, and when you see the cash flow stream here, so this is 160,000 rupees, right? It is 1,60,000 rupees, which is a cash outflow, plus we have the 10 lakh rupees. We have the 10 lakh rupees of the cash inflow in the first year. So you are discounting, because it is not to be discounted, it is in the 0 period. So it is equal to this 160,000 rupees. So not to be discounted, but we are going to discount it because it is coming at the end of the first year. So it is 10 lakhs divided by 1 plus R. But the next is not an inflow. Next part is again a cash outflow, and this outflow is again a value of maybe 10 lakh rupees, and now in this case you have to discount it at 1 plus R power 2 to make the NPV of the project 0. So it means in this case what will happen? The situation like this emerge. In this case, what will happen? You will have the non-conventional cash flows here. Because of these non-conventional cash flows, we will have the 2 internal rate of returns. One internal rate of return is 25%, because here NPV becomes maybe 0, and second is the 400%, where the NPV becomes 0. So which one out of these two will you will accept? Because of the cash outflows occurring at the multiple times. When the cash outflows not only occur in the zero period or in the construction period, but in the subsequent years also, means you have a zigzag kind of a trend, inflow, outflow, something like that, right? You are making subsequent investments also. So there you will get the multiple, you call it as a multiple internal rates of return, and accepting one out of these given rate of returns would not be so easily possible, means it will be incorrect. So we have to find out the way out, that how to use the internal rate of return, which is only giving us one value, and that value is useful for us, and finally we can take the decision on the basis of that value. And if we discount the cash flows by using that value of internal rate of return, so NPV of the project will become zero, right? That would be numerically correct also, logically correct also, and we have to use that kind of the situation. So one limitation, this is the first problem with IRR, that when there are the multiple inflows and multiple outflows, so you will get the multiple IRRs, and accepting one out of many will be a challenge. So we have to rectify this situation, and we have to find out some way where the internal rate of return becomes 1, and that is finally usable, and if you use that, NPV of the project will become 0. This is the first limitation. We will find out the way later on. Next limitation is the mutually exclusive projects, right? Normally, when you go for the capital investment proposals or evaluation of the capital investment proposals, we assume that we are going to deal with the mutually exclusive projects. That if we can take the one venture in hand, you cannot take the second one. You have to abandon the other one. You have, for example, the 4 ideas in your hand. So out of the 4 ideas, you have to select only one, and remaining 3 you have to abandon. So because they are mutually exclusive, you can take one, you cannot take other. You cannot take all the projects together. So if the projects are mutually exclusive, right, in that case, now what is the problem here? With the IRR, sometimes it communicates something which is not logical, which is not reasonable, and you call it as this is a kind of a miscommunication, and because of this miscommunication, a wrong decision can be taken. This is another limitation of the internal rate of the return, because you compare it in the percentage terms, and in the percentage terms, sometimes the value may be different. In the absolute terms, the value may be different, and if you want to take the decision only on the basis of the IRR, which is in the percentage terms, so it can lead us to something which is illogical, incorrect, and finally the decision to be taken may not be correct. So in this case, for example, you look at these cash flows. You are given here the 2 projects we have in hand, project P and project Q, and you are given here C0, that is the cash outflow in the current period, in the construction period, in the 0 period, and this is C1, first cash inflow coming in the first operational year, at the end of the first operational year. So this is talk about the project P. You have the C0, which is a cash outflow minus 10,000, right? And we have only 1 year of the operations of the project. After that, we have to abandon the project, and it gives us an inflow of the 20,000 rupees, right? Or you call it as a 20 lakh rupees. So 10 lakh rupees of the investment and 20 lakh rupees of the cash inflow. So how much is the return? In the percentage terms, if you see, it is 100%, but if you calculate the NPV at the rate of 12%, it will be 7857. That is a 7,857 absolute rupees. One, right? Now you go to the second project, project Q, right? And in the project Q, we can see here, so what is the total investment outlay? 50,000 rupees. It is minus 50,000 rupees. And what is the inflow coming out of it? That is 75,000 rupees, right? In the percentage terms, if you want to see, it is just 50%. And it is half of this one, the first one. But in the absolute terms, if you see here, it is 16,964. If you are going to select it on the basis of, means because it's mutually exclusive, you have to select one out of the 2. So if you want to select it on the basis of the IRR, so you have to select the project P. But if you want to select on the basis of NPV, you will select the project Q. So project R is giving us a result or a decision that the total, you call it as internal rate of return is 100%. We are investing 10,000, we are getting 20,000, maybe the discounted value, and finally the return is 100%. In the second case, it is half, it is 50%, but if it is the absolute value, if you look at the absolute value, there is a significant difference. So in the mutually exclusive projects, where only one can be taken, not all can be taken or multiple can be taken, if you have to take only one and you have to abandon the other one, and if you want to take the decision on the basis of percentage return, which is internal rate of return, so sometime it can lead us to a wrong decision, wrong the calculations, wrong outcome, because as per the NPV it will be different, and as per the IRR the decision would be different. That is the reason that one way of removing or dealing with this limitation is that you calculate both. You calculate NPV also, you calculate IRR also, and then see that if the projects are mutually exclusive, then you check it, what is the IRR, what is the NPV, and finally take a call by looking at both the things, IRR also and NPV also, and then finally take a call. So this way you can rectify the situation to some extent. Another important limitation of this or the problem with the IRR is lending versus the borrowing rate, right? Now you look at this picture, right? Here we have the two projects again, A and B. Project A, project B. Here we have the two, say we call it as the cash flows, C0 and C1. C0 is the in the construction period or maybe the current period. C1 is the first years of the cash inflow. IRR is here given as the first discounting criteria, and second one is NPV, discounted cash flows are discounted at 10%. Discount rate is 10%. Right. Now, the first part, if you look at, it's an investment proposal. Project A is the investment proposal. It's clearly showing that you are investing 4,000 rupees in the zero period, in the current period, and in the first year you are getting 6,000 rupees, and internal rate of return available from this venture is 50%. And the absolute value, the NPV available is the 1,455, right? It's clear. Second, if you look at B, if you are a person who doesn't know how to apply the capital budgeting techniques, and if you only look at these figures, so you may take a decision which is not a correct decision, which is not a worthwhile decision. So in the second case, you would find out if you look at only these two things, IRR and NPV. So here the IRR is 50%. In the second case, the IRR is basically 75%. In the absolute terms also, the NPV is 1,455, and in the second case, it is 2,364. So what do we conclude out of it? We have to understand it that the project A is the investment proposal or the maybe a venture which we are going to create by investing 4,000 rupees. So it is you call it as making the investment, or it's first 4,000 is outflow and 6,000 is the inflow. So one is the lending decision. Lending means to making investment in the project. When you are lending this 4,000 rupees to the venture, right? Because venture is also considered as a legal entity. So owners sometimes lend the money to the venture. So this is an investment proposal because 4,000 you are lending, and that investment is going to return you 6,000 rupees. So fine, you are going to misevaluate it because the internal rate of return is 50% and NPV is 1,455. But the second is the borrowing proposal. Second is not lending, second is the borrowing, because 4,000 is positive. So 4,000 is not going out of our pocket as investment. 4,000 we are borrowing from some source, and then we are returning against that 4,000 rupees of the borrowing after 1 year period of time. In the C1 period, we are returning 7,000 rupees back to that source. 7,000 rupees we are returning, though in the percentage terms it is 75%, but this is the borrowing rate. You are borrowing the money at 75%, and net payment you are making, which is 2,364, which is more than this inflow which is going to come to you in the form of the NPV 1,455. So one is lending, one is borrowing, and distinguishing between these two is very important. Before applying this technique or taking any decision by using this technique, you have to distinguish between these two, and then you have to understand that what is the difference between the investment and what is the difference between the borrowing decisions, simply not to go by the percentage or the absolute value. So this is the third important problem with the IRR, and we have to understand it. And there is one more problem which is not maybe described here, but this fourth problem is the difference between the short term and the long term interest rates. Because in the real life scenario, when you are into the business, you borrow the funds at the different rates of the interest. Long term borrowings, the rate of interest is different. Short term borrowings, the rate of interest is different. So you have to finally find out only one rate which we call it as the internal rate of return. So it means if you are say short-term funds are invested in some one particular part of the project, and long-term funds are invested in the other particular part of the project. So long-term funds are giving you the return like that, short-term funds are giving you a return like that. So finally, you have multiple discount rates. Means whether you will use the long-term discount rate or you will use the short-term discount rate. So some people say that we should take the average or the weighted average of these multiple rates, and finally we should make it one, and then we call it as its the internal rate of return. We should discount the cash inflows coming out of that venture. But still it is a problem, because calculating means exact means weighted average of the different sources, different rates of borrowings, long term, short term, that will also create a problem. So it will not be possible to exactly find out the internal rate of return when we are using the funds from the multiple sources. So these are the four important problems, right? These are the four important problems which are going to create the problem for us while we are going to make use of the internal rate of return. So we have to find out the remedy to deal with these four problems. And finally, though the IRR is a very, very useful investment criteria, investment evaluation criteria, you cannot totally ignore it, that there are some problems, so we will have to completely ignore it. It's very good, very useful. It's in the percentage terms. Only thing is, you have to understand these limitations, these problems. You have to do away with these limitations and the problems, and finally find out something which is acceptable IRR, and which is logical IRR, and which is free from all these kind of the problems, and which is free from all these kind of the limitations. So we will have to misuse some internal rate of return, and that internal rate of return would be called as a modified internal rate of return. So in the normal course, if the cash flows are conventional, that you have only cash outflow in the zero period, and in the subsequent foreseeable period there are only cash inflows, you can easily use the internal rate of return. You can find out the discount rate where the NPV becomes zero, and that would be our IRR also. But if it is a non-conventional cash flow, certainly we will have to rectify that problem, where in the zero period you have cash outflow, in the first year you have inflow, second year you have outflow, next 2 years you have inflow. Again the say further investment is required to be made, so you have in the 5th year or the 6th year you have to make again the outflow. So that becomes a non-conventional cash flows. There simple IRR cannot be applied to evaluate that investment proposal. There you have to use the modified internal rate of return, right? That is the way out. To correct that situation, rather than using the simple internal rate of return, we have to use the modified internal rate of return. So what is the modified internal rate of return, how to make use of it, and what are the properties of the modified internal rate of return, how it is better than the simple internal rate of return, that we will discuss in the next class. Till then, thank you very much, and in the next class we will meet and discuss the modified internal rate of return. Thank you very much.